I just bought $46,000 of Microsoft stock. This is my biggest move of 2026. I completely sold out of my position in Visa, a company that I've held for many years, and I took all of that capital combined with a lot of new cash, and I dropped over $46,000 into Microsoft stock after the earnings crash. In my dividend growth portfolio, this is now my largest position, just under $100,000. And I actually bought even more Microsoft in other accounts, bringing my overall position to 261 shares or $112,000. So why did I make this move? Why did I sell Visa? Well, it's not because Visa is a bad company. It's actually a fantastic company, a great business. My logic entirely has to do with Microsoft. In my opinion, it's an even better business trading at a more attractive price with higher growth prospects. In this month's portfolio update video, I'm going to explain why I made this move, the opportunity cost logic behind these transactions, and a full update on all the other stocks that I bought this week, as well as what dividends I can expect next month, which will be my highest month of dividends ever. With that said, let's roll the intro and get into this portfolio update.
The following reflects the opinions of a man who spends far too much time thinking about stocks. Please do your own research before making any investment decisions. Nothing in this video is personal financial advice. Continue at your own risk.
My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. Throughout, I will be using my stock research platform over on dividenddata.com, which I use to track my portfolio and do in-depth stock research. I'll be using these tools throughout. I would also like to mention we are in the early access period of our spreadsheet add-on. This allows you to access all of our stock data going back 30 plus years in financial history, and you can get this data directly in your spreadsheet. It is currently available for Google Sheets in our little beta test. I just finished development on Microsoft Excel and it is submitted, so we got to wait for approval. And this is going to be the biggest update to dividenddata.com we've ever had. There's going to be a lot of changes coming up, including price changes for new customers. But if you want to be early and one of the first grandfathered in members, you can join the early access sale that we have right now, where you can get 50% off annual membership. You get to try the spreadsheet tools before anyone else, and you get to lock in a discount price that we only offer in our biggest sales of the years, things like Black Friday. And this exact price for what you're going to be getting, it's never going to be offered again. After the official launch of the spreadsheet tool, we're going to have tons of changes, and in order to get what you're going to get here, the base price for that's going to be higher. So now is the time to join. You can lock in with the early access sale, link in the description and pin comment. Now let's get into the portfolio update. First, I'm going to address the elephant in the room, especially since many of us in our community own this stock, Visa. Why did I sell it? Well, first off, I would like to just say Visa is an incredible business. I even just made a video 2 weeks ago how I thought the market was not fully respecting the company, and that purely looking at Visa in isolation, I would be a net buyer on the news of regulatory oversight here. I've gone over their business model in the past. It's great, extremely high margin, it's scalable. And as being part of my dividend growth focused portfolio, this was much more on the total return end of it. This is not a high yield stock, it's under 1%. So in that section of my portfolio, it was very comparable to something like Microsoft. They were there to accomplish the same goal. And Microsoft was already one of my core positions. And I kind of just viewed this as an opportunity to consolidate and go even heavier. Microsoft is now actually trading at an even cheaper valuation based on their earnings per share than Visa, around 27 times based on the trailing 12 months GAAP earnings per share, with even higher earnings per share growth. And I think the market is completely getting Microsoft wrong. Over the past few months, they've been getting more bearish on the company. They think it's getting riskier when I actually think it's getting de-risked. I think the long-term growth story for Microsoft is becoming more and more clear, and they're going to capture a slice of a ever-growing, expanding pie. You can already see the fast earnings per share growth they've been going on, and this is due to the growth of Microsoft Cloud, both in their Microsoft 365 Cloud bundle and in Microsoft Azure, so cloud hosting, infrastructure, and software. And my reason for buying Microsoft stock is that all of that is getting accelerated. And I think they're set for a decade plus of continued high growth. Analysts are projecting 15 to 20% earnings per share growth, and I think that's highly likely to happen, and if anything, might be conservative. If we head over to the AI analyst over on dividenddata.com, you can type in any stock like Microsoft PE ratio, and you'll bring up this chart here. And you can see that because of this new Microsoft sell-off, their forward PE ratio is 25. This is historically one of the lowest P ratios you'll get for Microsoft stock on a forward-looking basis. The company is nearly trading as cheap as they did during the fall 2022 sell-off, which I first used to build up my Microsoft position. And one of my main regrets at that time was not going even heavier back then. And I am now doing that. I am going heavier. But the key difference is the growth story back in fall 2022 was very different than it is today. That was pre-AI boom. I thought Microsoft had a clear path to growth before any of that even really started ramping up. And now I think their path to growth is clearer than ever and be far accelerated than it could have been. And if you want to know my full thoughts on why I think that, I just made like a whole 25-minute Microsoft stock review video. I went over their latest quarterly earnings. I did a deep dive on it. I basically gave my full investment thesis. So after you watch this video, I recommend you go back and watch that one. But I'll go through the basic bullet points here of my thesis. One, people are not properly valuing AI. They're not thinking about it the right way. Most people, they're just thinking about chatbots, which is like the main way people are using it, at least for now. That is already starting to change though. The proper way, in my opinion, to think about it is as digital intelligence. The idea that we can manufacture intelligence. And this inference from the models that are created in the industry, they call these tokens. And Microsoft and these other large cloud providers that are building data centers, these are basically intelligence token factories. They are manufacturing intelligence, which is being applied to countless different domains. And on Microsoft's earnings call, and basically every single earnings call of anyone involved in this space, the demand is far greater than the supply. And that demand curve is going to be exponential. One of the main reasons why Microsoft stock has been selling off is because people are very worried about their CapEx numbers, capital expenditures, and whether or not they're going to get a return on that investment. In the latest quarter, Microsoft spent $29.8 billion in CapEx. That was up $10 billion from the quarter before. And over the past 2.5 years, we've seen their quarterly CapEx go from $9 billion to $29 billion. That rapid expansion is due to this data center buildout. But Microsoft is not just lighting money on fire. If we look at the latest quarter, Microsoft is growing their Azure cloud business 38% year over year in constant currency. This has been accelerating over the past year. And I listened to the latest Microsoft earnings call, and they were saying that this was a conservative number, and if they wanted to, they could push this into the mid 40% growth. They actually use some of the infrastructure for their own AI products. Think Microsoft Copilot, the new Agent 365, I'm going to be talking about that. And then also just hosting their entire Microsoft 365 cloud infrastructure. But the big point on the earnings call is that they are supply constrained, and they could be growing a lot faster. So people are viewing this CapEx spend as lighting money on fire with risky returns. Meanwhile, I view it as an intelligent investment into infrastructure that is going to be used, that they are monetizing very well, both using in their own internal products, which are growing, and in their cloud infrastructure. We've seen their total remaining performance obligations, their RPOs, that is expanding rapidly just in the past year and a half, going from $266 billion to $400 billion. And then this quarter that they just reported, that jumped up to $231 billion. And now what people are upset about from that is that a large chunk of that money is going towards OpenAI, or at least contracted to go towards OpenAI. And frankly, I don't really get this whole complaint. If OpenAI suddenly can't afford it, it will all be 100% used, either by Microsoft themselves or other customers. It's like they're upset about booking contracts. They would have been investing heavily anyways. At least they have a contract lined up. Microsoft Azure is now their largest business, and it's going to be growing very fast. I think we'll see this growth stay this high. It doesn't have to get faster, but I think it could accelerate even more. Because Microsoft, they monetize the cloud through their software, Microsoft 365, and then the infrastructure side of it as well. And this has been a huge growth business. Their quarterly Microsoft cloud revenue has gone from $12.5 billion, that was like 6 years ago. That is now up to $51 billion a quarter. And despite seat growth and employee growth slowing at a lot of the companies, which is how a lot of software as a service like Microsoft 365 is usually charged based off of, but they're still expanding their average revenue per user because of Microsoft Copilot and all this new value that's in all these apps that people are paying for. And I do think Copilot and the AI integration into Microsoft 365, that's an underrated business. I think it will be highly profitable. But long term, I actually don't think that's where AI is going to have the biggest growth. I think it's going to be in the idea of digital employees and digital enterprises, humans and agents working together. You could even have autonomous systems of agents completing large sets of tasks. And by the way, if you're following the AI scene, we just had a huge breakthrough over the past couple of weeks with agentic use and all of this. Computer use and coding has gotten fantastic. And I think companies like Microsoft are going to be extremely well positioned to bring this idea of digital employees into the enterprise, the Fortune 500 companies. They're going to bring a more secure, trusted solution from a provider they all use. I think it's obvious, and that is going to be a gigantic growth industry. And Microsoft, they don't have a monopoly on it, but they're decently positioned. And this is one of those things where the pie is going to be growing so much, you only have to capture a slice of it in order to get a lot of value. So as we take a look at Microsoft stock, the valuation coming down and trading at historically more attractive multiples, it's looking like a no-brainer to me. I see their growth being very high, if not accelerating from this high rate right now. These CapEx investments, they're a no-brainer. What else is Microsoft going to do with their money? They have a fantastic balance sheet, $390 billion in shareholder equity. It's growing every single quarter. They have nearly $100 billion in cash and short-term investments. They're in a strong position. They don't have any debt issues. Negative $31 billion of net debt, so far more cash than they have in total debt. They're generating tons of free cash flow still while they're investing so much in CapEx. There are only a few companies in the entire world that can do this. It's really Google, Microsoft, Amazon. Well, Amazon invests in so much stuff that their free cash flow is not consistent. What people are not realizing is Microsoft was just in its weakest quarter of the year. This is every single year. The year prior, they only made $6.5 billion of free cash flow. This year is $5.9 billion. But the quarter before that and the quarter before that, they hit record free cash flow generation while ramping up their capital expenditures. They hit $26 billion in a quarter of free cash flow. This company rakes in money, and they're investing to be a leader in a high growth, very important industry that's going to transform a lot of the economy. So yeah, it's a no-brainer for this to be a core position of my portfolio. Overall, if we dive into my dividend growth stock portfolio, we just hit $311,000 in total value. So despite Microsoft going down a ton, I added a bunch of new money, so we're at all-time highs in terms of my monthly portfolio updates. Microsoft stock just under $100,000. I still have a 25% total return, despite half of this position being bought like right now. And I am not very diversified in this portfolio, and that's on purpose. People have a lot of different theories around it. In general, if you're a beginner investor or just want a way more passive investing style, I would recommend diversified low-cost index funds like the S&P 500. But I'm someone that's been hyper obsessed with investing for many, many years at this point. So I like to pick very focused investments I've done a lot of research on. And right now, this dividend growth stock portfolio, it's down to 6 positions. Microsoft is 31% of the account. HESM is just under 28%. That's a midstream oil and gas pipeline company. Google is 17.2%. The Altria Group is 19.5%. ExxonMobil is just under 8%. And MPLX, which is another midstream oil and gas company, that's 5.7%. So basically, as we look at this portfolio, it's technology oriented around AI and dominant market positions and energy, because energy is very important for AI. And a lot of these companies are very attractive. I've talked about HESM and MPLX. I find these two companies to be rare combinations of high dividend yield with high dividend growth. These are my cash flow compounders in the background. I'm still viewing these as core positions, and I'll be adding pretty much consistently month after month. Overall, this portfolio now pays me $12.5 thousand in annual dividend income. This was projected to do over the next year. That's $3.1 thousand a quarter, over $1,000 a month, $34 a day, $1.43 hourly. I got paid over $500 from Altria this month, and then next month it's supposed to be my biggest dividend that I've ever gotten. $2.2 thousand, $1,868 of that is from HESM, $342 of that is from MPLX, and these are all reinvested to acquire more shares, and I am looking forward to that. And if we look at my overall buys this month, I bought $46,561 of Microsoft. That was at a cost per share of $435. And again, I went through all of my logic of why I bought the Microsoft stock. I bought $1,000 more of HESM at a cost per share of $33.52. And then I bought $1,158 more of MPLX at a cost per share of $52.64. So that's $48,700 in total. I did sell $33,000 of Visa to help fund that. And I actually bought even more Microsoft in another account. So this was one of my biggest buying months I've ever done. Pretty big portfolio shift. But overall, I'm pretty pleased with my portfolio, especially on an overall basis. I think I'm well oriented for growth over the next 5 to 10 years. But again, I'll keep making money, keep adding to my accounts. Investing, it's a long-term game. Got to keep the long-term focus. In the grand scheme of things, I'm still pretty young. I'm 26 years old. So I'm much more focused on total return. I'm not in the preservation of capital and trying to live off my dividends right away phase. I just want compounding total return. And in my opinion, dividends are underrated as a part of that strategy as well, especially if we go into market downturns. But really, I'm just trying to find extremely high quality businesses that are growing. It's all about the businesses. When you're investing in stocks, it's not just a price, a ticker that goes up and down. You have to analyze the real companies underneath them. You're buying an ownership stake in a real business. So if you want to track and research stocks just like I do, head over to dividenddata.com. I built this tool so that you can actually analyze the fundamentals of a business. Great data visualizations that instantly let you realize the trends. As an example, when you look at the actual fundamentals of Microsoft in context of its price, it starts to make sense. Whereas if you just look at the stock price chart, you'd be like, oh, it's pretty high. But you realize you got this behemoth underneath it that has been pushing that stock price up. That's another reason why I'm excited about these spreadsheet add-ons. It brings all of the financial data of a company, all their financial history, every metric you want. You can build custom tools around it. And now that information's directly available in your spreadsheets, the tools a lot of you guys already choose to use. So as we're bringing out early access to that spreadsheet tool, and if you want to be one of the first people to try it, join our early access sale. You can lock in a discounted price. You get our web app terminal, plus you get this new spreadsheet tool, and you can lock in the best price we're ever going to offer. The link is in the description and pinned comment in the video. And if you enjoyed, please leave a like, comment, and subscribe, and I'll see you in the next one.